Today we are discussing add-backs, and we break them up into two expenses: non-business related add-backs and non-recurring or extraordinary add-backs. The key identifier on these add-backs is whether the expense drives revenue growth. If they do not drive revenue growth, they can be considered an add-back. Always keep this revenue-generating premise in your mind when determining what is considered an add-back. Non-business related add-backs are those expenses which are considered an owner's perks. These allowances or benefits are things that you receive because you are the owner of the business. These expenses a third party would not pay an executive to manage this business. The main one to consider is the owner's compensation. As the business owner, are you taking a salary and bonus that is above market compensation for the duties you perform? The difference between the amount of salary and bonus you receive compared to what an unrelated party would earn for these same duties would be considered an add-back. Also look at your family members who receive compensation above the market rate for their position, or compensation each year to family members who have no specific job responsibilities. Additionally, does your company pay for your personal vehicle? This category would include car lease payments to a finance company, gas, tolls, maintenance work, and repairs. Consider whether it is customary to offer a car allowance for the type of business you own. And don't forget about any family members who may be receiving a car allowance as well. You want to look at any expenses related to travel, and if these have been put through your company's financials. If the purpose of the trip was purely leisure and was not related to driving revenue growth, identify these trips to include in your add-backs. Additionally, common items that business owners typically have which can be considered an add-back are season tickets, memberships to clubs or gyms, and personal recreational vehicles, and the related insurance expense for these vehicles. Non-recurring or extraordinary add-backs are for expenses the business incurred resulting from business operations, but are not in the normal course of business. These would not be part of the core expenses needed to be incurred to deliver the service or good of your business to achieve your sales. Some examples of these items are one-time or exceptional discounts offered to customers, any donations made by the company for charity or political purposes that were not considered crucial to the continued success of the business, use of an outside placement firm hired to recruit candidates for key positions if such expenditures are not part of the company's typical recruiting costs. Any expenses incurred in the process of selling your company, for example, hiring PCE, your attorneys or accountants. Since these expenses are likely to incur in the future, keep them on the radar when preparing your financial statements going forward. Also look at your bad debt expenses. If you had an excessive amount in the historical period, typically the last 3 years, provide support for the normal level of bad debt reserves recorded for your business, and list the extraordinary items or events that led to the one-time large bad debt expense. Review your capital expenditures and how you recorded the purchases on your financials. Identify items that for some reason were expensed rather than capitalized according to your usual procedures. Adjusting these by applying your standard policy for capitalizing expenses will provide a more accurate picture of the company's profitability. And finally, look to see if you had any significant one-time expenses incurred by your company during the past year that will not continue going forward, are considered non-recurring expenses, and can be added back to normalized income. Let's look at an example of how these add-backs increase the value of your business. Prior to any adjustments, your company has an EBITDA of $10 million. And assuming a purchase multiple of 6 times, your business is valued at $60 million. You have identified add-backs totaling $2 million, which results in an adjusted EBITDA of $12 million, which, using the same purchase multiple as before of 6 times, your business is now valued at $72 million, a value increase of $12 million. While an investor or potential acquirer may have a differing opinion on the adjustment amounts discovered during the due diligence process, having a supportable list of add-backs and amounts will establish a solid basis for negotiations in determining the normalized profitability of your business. Thanks for joining me today. And if you like this video, Please subscribe to our YouTube channel so you'll be notified whenever new content is posted.